Now, without further ado, it is my pleasure to introduce today's first speaker, Sanjay Panaya, SVP in Ipsos's innovation team. Sanjay, you have the floor.
Excellent. Thanks, Ellen. And thanks, everybody, for joining my colleague, Chris Palmer, and me today for this webinar on the future of fintech and what to expect in 2021. So in today's session on the future of fintech, we'll start with who we are, a brief intro, and setting the stage. Then we'll get right into it. We'll talk about fintech trends we've been tracking, themes we've observed, and specifically our take on what to expect in 2021. One point I wanted to make at the top here, we've focused primarily on the US fintech space. I know we have a few participants from international markets today, and perhaps from markets where fintech is more advanced or less so. Anyway, I hope you'll find our more US-centric observations still valuable, and hopefully you can see how you can apply them in your own market as well. Finally, we'll wrap up with a quick recap and what else we'll be watching for in the fintech space in the future. So quickly about who we are. For those of you who don't know us, Ipsos is a global leader in market research as well as public opinion polling. We've been in business for over 40 years, have a presence in more than 100 markets around the world. We are a passionately curious team of researchers seeking to provide a total understanding of society, markets, and people. And Ipsos does work across industry verticals. We have strong established practices in several sectors, and financial services and fintech is a particular specialty. Chris and I are in the innovation and product development specialism within Ipsos. We focus on consumer and B2B and end user testing and development of products and services. Essentially, proof of concept work and value prop development work in technology, financial services, and fintech spaces. We're involved from early stage idea development, concept product development and design, product optimization, validation, go-to-market strategies, product launches, and beyond. We also do test ideas on our own for R&D purposes and to keep up with the space. And in fact, we do have a few consumer case studies that we'll share with you today as well. So before we get into themes and trends, let's set the stage. 2020 was another strong year for fintech. There was heavy funding, fintech funding here in the US that's coming on the heels of an exceptional 2019. There were 13 fintech unicorns with valuations of more than $1 billion that were created. There were several high-profile fintechs that went public, including Lemonade, Root, and Affirm, although Affirm may have been Jan 2021. On the consumer side, we saw a dramatic acceleration of digital adoption as we went into the pandemic, and this was across the board in fintech. It was with mobile payments, mobile banking, investments, lending and financing, in all fintech spaces. And then finally, when we did the 2020 edition of our Future in Fintech webinar, it was in March of 2020. We were just going into lockdown with the COVID pandemic, and we faced an uncertain future. When we ended 2020, the first COVID vaccines had been authorized, and everybody was looking hopefully towards a recovery and returning to a new normal. Okay, one other point to set the stage. There are two very distinct and unequal experiences of the COVID pandemic and its aftermath, which you may have seen data about and read about as well. And some segments of the population, notably the affluent and the wealthy, did extremely well and saw an increase in wealth and savings, while other segments faced increased unemployment, reduced savings, heightened financial hardship. And looking at Ipsos data, this is from February 2021, we see younger folks, lower income segments, people of color, disproportionately struggling financially during the pandemic and after. In fact, these numbers have been diverging and getting worse since last summer when we last gathered these data, with lower income households in particular, but also others, younger folks and people of color, particularly struggling much more in the over the past 6 months. So we do expect this divergence to continue and lead to what is being referred to by many economists as the K-shaped recovery. This growing disparity, though, and its impact and this need for financial inclusion is one of the overarching themes of everything we're going to talk about today. And we'll dig into what providers and marketers can do about it and why we think the time to act is now. Okay, with that backdrop, where are we going from here and what can we expect in 2021? Here are the 5 themes or trends that we plan to talk about today. And we'll start first up with digitization getting sticky. With the COVID pandemic and the lockdowns and restrictions that came along with it, that really accelerated and almost forced the adoption of digital financial services, whether that was how we paid for purchases or how we banked. And Ipsos data that we gathered shows 25% of consumers over the course of a year since the start of the pandemic tried for the first time contactless payment methods, and that includes mobile payments, paying with a smartphone, contactless card payments, as well as P2P payment methods. And 13% tried digital banking for the first time, whether that was using their bank's mobile app or a fintech banking app. More importantly, though, it's not just millennials and affluent consumers who are making the switch to digital. We saw that these numbers hold for those who are 35 to 54, those with middle incomes, 50 to 100K in household income, and these numbers were much stronger with people of color. These numbers have also ticked up steadily. They were about half as strong last summer and have increased steadily since then. And these are pretty dramatic increases in adoption and first-time usage numbers. What banks and payment providers, fintechs have been trying to do for several years with digital adoption has effectively been pushed through in 12 months. And the question, of course, is, will consumers stick with this digital adoption? And our data says, yes, they will. The majority of these first-time users of contactless payments as well as digital banking say they'll continue to use these digital financial products and services post-pandemic. And those numbers hold steady with some segments beyond affluence and millennials, and even increase with some of those more vulnerable segments as well. So as these data on digital adoption show, COVID has definitely facilitated financial inclusion in some vulnerable segments and areas, but given the expected K-shaped nature of the recovery, some risks of leaving vulnerable segments behind still remain. So as the push to digital continues, are we collectively doing enough to not alienate those most vulnerable segments, including the lower income households, older consumers, those who are less tech savvy, or those who have the least access to technology? And the implication for providers, all providers, banks, payment companies, fintechs, is pretty clear. The increased digital adoption is pretty much here to stay, and providers must be prepared to create better, superior digital functionality and much more seamless experiences. And the challenge, as well as the opportunity for banks and financial services firms, is how do you ensure that you're considering the needs of all segments, not just millennials and affluents, and how do you ensure that this shift online draws in those who are currently underbanked or unbanked or less tech savvy or other vulnerable populations rather than further alienating them. Okay, with that, over to Chris for the next theme.
Thanks, Sanjay. So I'm going to take us through the next theme, which we're calling Money in a Pinch. And it's all aimed on a few new product innovations that we've seen popping up in a number of places that all effectively give consumers money when they need it most. So here are the three solutions that we'll be highlighting: buy now, pay later, or point of sale financing through providers such as Klarna, Affirm, and Afterpay; overdraft protection, and this is above and beyond what maybe you would think of as a traditional overdraft protection solution, where they might just freeze your account and not charge you a fee. Chime and Dave will actually let you overdraft and let you continue to overdraft up to a limit. And Chime recently announced that they raised that limit. It was $100, now it's $200. And then the last one is paycheck early. So Chime will give you your paycheck 2 days early for no fee. Earnin will give you your paycheck even earlier, but you do have to pay a small fee. All of these are aimed at giving consumers cash to float them to a specific date or money when they need it most. But the natural question is, all of these are out there, but what do people actually want and why? So we asked consumers, we had them choose which option they preferred. What's not shown on this slide is that we also included an option for a small loan. So basically everything outside of a traditional credit card, and asked them to say which do they prefer. If you look at the blue bar on the left, the total group, you'll see that there's a slight preference for overdraft protection. But what's really interesting is if you look into the different segments that we're showing here. So that teal bar, the lower incomes, you see they have a stronger preference for overdraft protection. Those that prefer point of sale financing or buy now, pay later, those are the higher incomes and those that say that they never miss a bill payment. And then interesting on the attitudinal side of things, those who don't trust large institutions and those who like new providers, they favor paycheck early. And it's not just that these are stated preferences. We gave them a list and they pick something that they like. We actually tested Chime. We've tested Chime twice, before and after they introduced overdraft protection. And both times it's come out as a niche, and I'll walk you through how we get there. Every time we evaluate an innovation, we ask some key measures, which are shown here: likelihood to seek additional information, 2 cuts at purchase intent, the top box, or definitely would, we call commitment, top 2 box we call broad appeal, definitely or probably would, liking, value, uniqueness, believability, and need fulfillment. And we compare those scores to our database of other similar concepts that we've tested to get a sense of overall potential. And that potential is shown with the colored circles. So darker or brighter green would be the top 20%. So it's in the top 20% of things we've tested on that metric. Light green above average, gray average, light red below average, and then the dark or brighter red would be bottom 20%, and nothing for Chime shows up there. We call it a niche because it has average broad appeal but strong commitment, and that story meshes exactly with what the CEO of the company, Chris Britt, says about the company. They're only going after lower incomes. So the 2 innovations that they introduced are paycheck early and overdraft protection, which fits perfectly with the preference metrics that we saw in the last slide. But what's especially encouraging about overdraft protection is when we look at our messaging evaluator. Essentially what we do here is we break the concept down into individual phrases and have respondents select things that they find most relevant to them, least relevant, most unique, and hard to believe. And if you see within most relevant, most unique, and even hard to believe, we see the overdraft benefits popping up there. So they're relevant to consumers, they're seen as unique, maybe even too good to be true. So it's not just that consumers and the lower income consumers like overdraft protection, it's actually driving interest in the Chime value prop, which has done quite well for itself. So what does this mean for 2021 and for providers? In 2021, we expect more to begin offering similar solutions, whether it be buy now, pay later, added overdraft protection, or paycheck early. But you have to be aware when you're introducing these innovations, who it's designed for and who's going to use it. If you just go with buy now, pay later, are you alienating a lower income group? If you don't introduce a paycheck early, are you alienating those or lacking to draw in those who might already have a distrust towards you? So it's important to make sure you have an inclusive offer that's drawing in everybody and not just focused on maybe the affluents. It's also important to note that we've seen some firms kind of take a half step at some of these innovations, like the paycheck early. It's based on when the ACH transfer is placed by the employer. So sometimes that's not 2 days early. Sometimes that's only hours before, and that creates some a distrust between the provider and the customer. They thought that they were going to get money 2 days early. Instead, they got it six hours early. They were relying on that money to make a bill payment, and now they can't. So we advise that if there's risk to be had, we would advise that you take the risk to live up to the promises that you're making to the customer. And that's kind of how you build long-term trust, and you can grow with some of these vulnerable segments as they maybe aren't as vulnerable later in life. I'll hand it back over to Sanjay.
Awesome. Excellent. Thanks, Chris. Next theme we're going to talk about is rebundling the offer. And fintechs, typically when they begin, they focus on a single product or a single underserved segment. And increasingly, though, the fintechs have started to expand their breadth of services in an effort to deepen customer relationships and have started to challenge banks in that process. And a few recent product introductions from fintechs that exemplify this trend. Acorns, including introducing IRAs and checking, Betterment looking at checking and savings, Square looking at checking and savings and investing as well. Chime and Affirm both announcing credit cards. And in some ways, there's no better example of this trend than SoFi. A deeper dive on SoFi, they started in 2011 as a student loan refinancer, expanded into mortgages and personal loans, then began to offer investing services with SoFi Invest, and then their robo-advisory, SoFi Automated Investing. Most recently, they've launched a Apple Pay equivalent, Samsung Money by SoFi, and they're looking into banking and have also announced a credit card. So they've expanded their product footprint dramatically, relative to where they started, 10 years ago. And the SoFi product and the offer itself is also something that we've tested on our own for R&D purposes. We tested two versions. One was the base SoFi offer, a heavy emphasis on loans, personal loans, student loans, mortgages, as well as the SoFi Invest offer, focused only on the investing piece. And when we look at the scores on those same KPIs of consumer demand that Chris walked through, we see strong commitment for both SoFi as well as SoFi Invest, and there's more moderate broad appeal. Again, indicating that these are both niche targeted innovation archetypes, the way we think of them. So in terms of personality profile of the concepts, both of them are niche and targeted. By introducing SoFi Invest, you might think, SoFi is going after potentially a broader audience, but really the focus is on deepening customer relationships, and SoFi Invest is also a niche, and SoFi is really going after the same audience. The SoFi Invest benefits that resonate include, commission-free trading, low costs, ease of use, and that's very much aligned with the base SoFi offer as well. And the idea is to seek to reinforce and strengthen the SoFi brand overall. So as as SoFi seeks to become more of a one-stop shop for financial services for these very specific population segments, they'll continue to challenge banks in that process as they expand their product footprint. So as fintechs in general broaden their services and deepen customer relationships, what does that mean? They pose obviously a bigger threat to established players and to banks, of course, as they advance further into banks' territory. When SoFi started and they focused on student loan refinancing.
Looks like we might have lost Sanjay. Sanjay, can you hear?
Oh, you lost me? No audio?
No, Sanjay is there.
Yeah.
Sanjay, go ahead and continue. I will double check
Okay.
with Chris.
Perfect. So, as I was saying, when SoFi first started and they focused on student loan refinancing, that may not have been mattered as much and may not have been as much of a threat to banks and established firms. But as they expand their product footprint, they obviously pose a greater threat. And for banks and payment providers, continue to expect the unexpected when it comes to fintech competition. Don't take for granted that only the fintech directly competing in your space needs watching, and especially be willing to pursue segments and or defend niches before fintechs advance into those spaces. And with that, I'll hand it back to Chris.
Thanks, Sanjay. So we've made it this far into a presentation about 2020 in fintech and what to expect in 2021, and we haven't talked about investing yet. I'm sure people saw this coming. So this trend's about investing, and we're calling it Educate, Don't Gamify. But we have to start with a discussion of what happened in 2020 and COVID's impact on the market. So first, I just pulled Dow Jones performance basically throughout COVID to show what a roller coaster year it was. Sharp decline right as COVID kind of swept across the US. But at this point, we've recovered all of that market value and even surpassed it. And that quick recovery is due to a number of things, primarily Federal Reserve activity, especially holding interest rates low. But consumer trading also played a large role in it. So the move to no commission-free trading meant that everyday investors were much more engaged than they would be in the past. Stimulus money and kind of a broad net stimulus money, even to those that didn't lose employment, meant that people had balances to commit directly into brokerage accounts. And then also general boredom, surprisingly, led to more active traders, more people involved in the business, in the stock market and other equity markets, as things like sports and just general going out wasn't possible during lockdowns. So it's not only that we've had this sharp recovery where kind of everybody was making money after a sharp decline, but it's also led to this different perception of the stock market. And we have a Wall Street Journal headline that I think embodies it pretty well. Robinhood traders battle cry, it's all just a game to me. So people are thinking about it a little bit differently. There's a lot of FOMO going around with investing, and that kind of sets the stage market-wise for what's going on in 2021. So one of the providers that really fueled some of the craziness throughout 2020 and will continue to fuel in 2021 is Robinhood, and these findings carry over to other Robinhood-like solutions. We tested Robinhood using the same key measures that you've seen with SoFi and with Chime, and it came out as undistinguished. So nothing above average on anything. And I think most importantly on uniqueness. And I think this would have been surprising if I showed this to you more than a year ago, pre-pandemic. Robinhood was seen as a very unique solution, not only because of its commission-free trading, but also the different products that they offered. And the shine's kind of worn off it in terms of a product. But there's also been a backlash from regulators and the general market. So the SEC is looking into Robinhood and other providers to see if their gamified experience is actually designed in investors' best interest. But I think maybe even more importantly, there's been lost trust with Robinhood and similar providers throughout the rise and fall of equities such as AMC and securities such as Dogecoin. And we have 2 tweets from Robinhood that kind of embody that, going into a weekend in which Dogecoin was on the rise. Robinhood tweeted out, "We're all paws on deck all weekend." And then if you look at the timestamp, it's only a few hours later, they tweeted out that they're experiencing some issues with their cryptocurrency trading, which suspiciously coincided with kind of forcing a fall, a drop in the value of Dogecoin. And a similar thing happened with the rise and fall of AMC. So we have these two trends kind of converging, a crazy market recovery in which a lot of people are saying, throughout the past year, I've done nothing but make money in the stock market. Stocks only go up is even a phrase that people are saying. And then there's also kind of this shine wearing off providers that were seen as unique or differentiated pre-pandemic. And what that means is there's an opening for traditional providers. And we're saying that it's fighting FOMO with education and preparation. So while there hasn't been a strict market correction or anything like that for the steep recovery, it seems like we're getting to that time of the recovery where there will be some level of correction. And even if there isn't a full market correction, it's almost certain that certain securities or certain equities will self-correct. And we've seen that with the likes of Dogecoin and with the likes of AMC. And people who enter into those markets because of FOMO, they don't know much about investing. So they start investing there because everybody else is, and then they get burned because they don't know when to get out. They're likely to either change providers or leave the market altogether. So traditional providers have a role to play here in saying, we're not here to gamify the experience to get you to trade more. We're here to tell you how you should be investing, prepare you for a market correction. And that type of education and that type of relationship is a client that you're going to keep for the long run, and it won't be a quick burnout in terms of the client relationship, as we've seen some people kind of burn out on Robinhood in a matter of months. Back over to Sanjay.
Perfect, thanks, Chris. So final theme for the day is about going from an emphasis on environmental only to an emphasis on the entire ESG, all 3 parts of it. So financial services firms and fintechs have focused on environmental impact for some years now. There are lots of fintech examples, even across different spaces. In banking, for example, the Aspiration, it's a digital bank that won't use consumer deposits to fund fossil fuel projects. In payments, you have things like Doconomy, which is a Swedish digital bank. They've recently introduced a credit card with a CO2 cap on spending. The credit card allows you to monitor purchases based on carbon emissions and puts a cap on spending based on your impact on the climate. And in investments, there are a number of examples: Betterment, Personal Capital, and others that have ESG investing options that primarily focus on the environmental impacts and avoiding investments in companies that are directly or indirectly involved in fossil fuel projects, for instance. So environmental has been done a lot across fintechs and across financial services. But of course, in 2021, social is much more important in the S in ESG. This Ipsos data shows consumers do care about the environment, but they care as much and maybe more about many other social aspects, so racial equality, gender equality, income equality, etc. And that cannot be ignored. In fact, brands, companies, providers are expected to take a stance on social issues much more than in the past. And as we saw earlier, people of color, lower income consumers continue to feel pandemic effects disproportionately. So providers emphasizing financial inclusion of these most vulnerable segments, and then building financial products, services, functionality that really support these most vulnerable segments, and therefore these issues will be successful. And a recent example of this is as we see, credit being offered without referencing FICO scores or the traditional credit checks, as a way to, introduce financial inclusion for these vulnerable segments. Okay. In addition, when we asked consumers who they most trusted to protect their financial data, banks, fintechs, or big tech, or the government. Well, first, a lot of the purple number there is a lot of people chose none, which of course mirrors the lack of trust in institutions, probably. But of the rest, banks were most trusted, and fintechs and big tech much less so, and very far behind. And so as fintechs particularly navigate, very thorny data ownership kinds of questions, especially in cases where they have partnerships with banks, in a banking as a service kind of setup, they face, data governance kinds of challenges. In order to gain consumers' trust, they face a pretty uphill battle, and banks have an edge there, because they've already kind of been doing this for a while. The other thing about this is, fintechs, and especially private fintechs, have often skated by without too much attention from regulators. But the Wirecard debacle in the UK, if that's taught us anything, it's that fintechs are going to be increasingly scrutinized more by regulators, as well as investors and consumers, and will require fintechs will require a much more concerted focus on governance. And again, here banks have the edge, having already had to comply with greater regulations and the historical sort of emphasis on governance issues, going forward. So at the end of the day, what does this mean? Consumers will end up focusing or using a number of factors when they choose a financial services provider, and brands, companies, products, organizations that recognize all of ESG, not just the environmental piece, but the social and the governance aspects as well, will resonate much more strongly. And with that, I'll hand it back to Chris to talk more about these implications and to wrap up.
Yeah, so let's wrap up. We talked about a number of themes today, but let's talk about how they all fit together and what it means for providers. Starting with the point Sanjay left it on, consumers are really deciding on more than just feature sets and pricing when they make decisions, especially decisions that relate to a longer term relationship, such as opening an account with a financial provider. And we've seen heightened focus on issues, social values that kind of set the stage for winners and losers for the years to come. And part of that heightened focus has been the disparity that COVID has brought about and the K-shaped recovery that will continue to alienate certain segments. We touched on a number of them in this call, but to point out a few, the non-tech savvy, the lower incomes, different ethnic groups, and then the less financial literate. So what that means for providers is you have to be constantly keeping in mind these different groups, especially as they grow more and more apart. So as you think about closing a branch or closing a telephone line, are you accounting for your customers or potential customers who are lower or less tech savvy? As you think about introducing a buy now, pay later solution, are you thinking about how that helps lower incomes consumers who really need money to pay bills, not to finance a new expensive couch or something like that? And for your investment platform, are you considering introducing any educational material or anything like that to advise the less tech savvy or the less financial literate who may be more prone to falling into fear of missing out and kind of buying into something like AMC when it's at the peak of its bubble and things like that. It's not just that these are the right things to do. It's that they can actually have an impact on your business. So not introducing these innovations or forgetting about these alienated segments is not only turning away potential customers, but in this era of heightened focus on these issues, you also risk a backlash from your general customers who you already have. So COVID set the stage for who will win and who will take a step forward on introducing inclusive products. By going forward and introducing products, you can grow your customer base and take your brand image to the next level. And it's ultimately those that take the first step first who will win in the end. Those who lag behind probably don't get much goodwill, if any, for following those that move first. So now is the time to act. I want to thank Kevin Hung, who also helped out with this webinar along with Sanjay and myself. And now I'll open up the floor to questions.
Well, Chris, maybe you can take this one. I do see one question here. So, given all the attention on crypto, do you see more players offering this capability? You want to take that?
Yeah, I'm happy to take it. I do think, crypto's kind of been bubbling for a while, and I think now as more fintechs and the likes of fintechs start introducing it, I do think that we'll see some more traditional providers get in the game. Coinbase, a popular brokerage essentially or marketplace for crypto, IPO'd this year. So I do think we'll see more introductions of crypto capabilities from traditional providers. I guess what I would say is, going hand in hand with our note on investing, kind of educate, don't gamify, is if you're going to introduce a crypto capability, you bear some of the responsibility to make sure, or at least position it as a responsible way to invest, and not just introducing it because your clients have fear of missing out. Because if they are to get burned in crypto, an especially volatile market that's very hard to predict, they may change providers. They may also just leave. They may start saving more and kind of leave brokerage altogether. And that's a risk that you might not want to take if you're not going to invest the resources into making sure that, or trying your best to make sure that your clients are using it responsibly.
Excellent. Well, I don't see any other questions, so we can always get back. But thank you everybody, and thanks for joining Chris and me for this webinar. Ellen?
Yes, and actually I've seen a couple of questions just pop in, but in the interest of giving everyone some time back, we'll answer those questions directly by email following today's webinar. I just really want to thank Sanjay and Chris for today's really interesting presentation, and thank you everyone for joining us. Remember to be on a lookout for an email with a direct link to today's recorded presentation. And of course, at any time, we welcome the opportunity to speak with you directly. That now concludes today's webinar. Have a wonderful day.